right now, millions of people are injecting GLP-1 weight loss drugs. They're eating significantly less and, actively trying to avoid the snack aisle.
Yeah, the dietary landscape is just completely shifting.
Exactly. And meanwhile, you've got stubborn inflation and high gas prices squeezing wallets across the country. It's keeping consumers away from their favorite local bistros.
Which usually spells disaster for the food industry.
Right. Yet, a food distribution company just posted a $16.29 billion quarter, beating expectations by over $123 million.
It's honestly wild.
It is. How are they doing it? By basically turning those exact economic and biological obstacles into their primary profit engines.
It's a remarkable pivot, really. I mean, we are looking at a Fortune 100 company that has realized the business isn't just about moving pallets of food anymore.
Right.
It's about moving data, predicting human behavior, and completely re-engineering the supply chain to match shifting dietary realities like in real time.
And that is exactly our mission for this deep dive. So, welcome. We're bringing you along for an exploration of the hidden machinery behind the food you eat when you're not at home.
It's the invisible world of food service.
Exactly. We're looking at a stack of sources today, specifically the Q3 2026 earnings report and the full investor call transcript for Performance Food Group, or PFG.
They are an absolute industry heavyweight. They supply hundreds of thousands of restaurants, convenience stores, and vending machines.
Yeah, they are everywhere. And our goal today is to look way past the dry financial tables to uncover a really fascinating story. We're talking consumer psychology, the resilience of independent restaurants, and how a multi-billion-dollar operation navigates supply chain turbulence.
There is a lot to unpack.
There really is. But to set the stage, we have to start with the distinct paradox right at the top of their earnings report.
The top line versus bottom line split.
Yes. In this quarter, PFG's net sales grew 6.4% to that $16.29 billion figure. Total case volume was up 4.4%.
Which is huge volume.
Right. And their adjusted EBITDA, which, strips out non-cash expenses like depreciation, that rose 6.6% to $410.6 million.
So by almost every top-line metric, it was a very strong showing, especially in a macroeconomic climate where, consumers are supposedly pulling back on discretionary spending.
But then you look a few lines further down, and their net income, the actual bottom line profit on paper, dropped.
Dropped significantly.
Yeah, it decreased by 28.5% year over year, landing at just $41.7 million. So they sold more food, delivered more cases, brought in way more revenue, but their net income plummeted.
Right.
Okay, let's unpack this. How does a company beat top-line revenue expectations so thoroughly but end up making nearly 30% less on the bottom line?
Well, what's fascinating here is that in the world of high-level corporate finance, a drop in net income isn't always a glaring red flag.
Wait, really? A 30% drop isn't a red flag?
Not in this context, no. In PFG's case, it isn't a sign of weakness at all. It is the very calculated, deliberate cost of aggressive strategic expansion.
Okay, deliberate how?
To understand that, you have to look at their operating expenses. Those rose by 8.6% to $1.8 billion. They're intentionally suppressing their short-term profit to build a much larger, more dominant infrastructure.
See, when I look at operating costs jumping by almost 9% to $1.8 billion, my immediate thought is inflation and fuel.
Sure, which are real factors.
Right, because they specifically call out fuel costs and the miles driven to service new customers as a distinct headwind in this quarter. The CEO even mentioned a $7.3 million gross impact from fuel just in the final month of the quarter.
Yeah, that was a direct quote from the call.
So is this the cost of doing business getting more expensive, or are they actively choosing to spend this capital?
It's a combination of both, actually. But the voluntary capital expenditure is the real story here. The text outlines that they're spending heavily on recent acquisitions, higher personnel expenses to secure top talent, and a significant increase in depreciation from buying more transportation equipment.
So they're buying trucks and hiring people?
Exactly. Most notably, they are absorbing massive transition costs as they integrate new regional businesses into their national network.
Got it. So it sounds like they are remodeling a massive commercial kitchen while keeping the restaurant open for a fully booked dinner service.
That is a perfect analogy.
Right. You have to pay the contractors, buy the new commercial ovens, and still pay the line cooks overtime to execute the menu in the meantime. It aggressively eats into your margins today, but you end up with a high-capacity kitchen tomorrow.
That is highly accurate. They're running parallel systems right now to ensure they don't drop the ball for their current customers while they expand their footprint.
But I have to push back a little here. Holding cash to fund expansions is great, but burning it on fuel doesn't yield future returns like building a new warehouse does.
That's a fair point.
With overall inflation running at 4.5% for the company, at what point does this underlying operational cost drag them down? If diesel keeps eating into the margins, a bigger warehouse doesn't necessarily solve the profitability problem.
That is the exact tension the analysts on the earnings call were probing. But PFG has two distinct shock absorbers built into their model.
Okay, what's the first one?
The first is their liquidity. In just the first 9 months of fiscal 2026, PFG generated a staggering $806 million in free cash flow.
Wow, over $800 million.
Yeah, they have the liquid capital to weather the fuel volatility. But the second, and more important shock absorber, is how they are actively managing their gross profit. Despite the fuel drag, their gross profit actually improved by 6.4% in the quarter.
That seems really counterintuitive. If the trucks cost more to run, how are they making more profit on the goods inside the trucks?
It comes down to what the industry calls procurement efficiencies, combined with a highly strategic shift in their mix of goods.
Mix of goods.
Yeah, a company of PFG's scale doesn't just buy food. They engineer their purchasing. They use their massive volume to forward buy commodities at locked-in rates, hedging against inflation.
Ah, so they buy it cheaper before the price goes up.
Exactly. Furthermore, they're actively changing what they sell. They're steering their sales force to push specific items that carry an inherently higher profit margin.
Right, so by engineering the catalog to be more profitable per case delivered, they offset the higher costs of getting that case to the loading dock.
Precisely. It's a very sophisticated balancing act.
Which logically brings us to who exactly is buying those higher margin items? You might assume it's the giant national fast food chains driving this efficiency, but the data point's somewhere completely different.
Right, it's not the mega chains.
No.
Yeah.
The most compelling success story in this entire report is their food service segment, specifically the independent local restaurants.
The independent restaurant sector is the absolute lifeblood of their high-margin business.
Why is that?
Because national chains demand steep volume discounts. But independent operators rely on the distributor for a wider variety of specialized products, which yield much better margins for PFG.
And their performance in this sector was unprecedented. Independent restaurant case volume grew by 6.5%, comfortably exceeding their internal benchmark of 6%.
That's a huge beat for them.
Plus, net new accounts grew by 5.4%. But here is the paradox. On the call, management acknowledged a pretty sobering reality about the broader market.
The black box data.
Yes. According to black box data, which is a leading metric for the restaurant industry, there are consistent low single-digit declines in restaurant foot traffic nationwide.
So fewer people are walking through the doors of restaurants right now.
Exactly. So how is PFG selling 6.5% more cases of food if fewer people are sitting down to eat?
It really highlights a crucial difference between macro industry trends and micro-operational execution. It synthesizes down to one primary concept. They are aggressively expanding wallet share, or what the industry calls lines per drop.
Lines per drop, meaning when the PFG delivery driver unloads at the back of the local Italian place, the invoice physically has more lines on it. They are dropping off a wider variety of inventory than they did last quarter.
Precisely. PFG isn't just relying on restaurants serving more customers. They are convincing existing restaurant clients to buy a larger percentage of their total inventory exclusively from PFG.
Instead of splitting it up among 3 or 4 different regional suppliers.
Exactly. And the earnings call highlights two primary mechanisms driving this consolidation. The first is a major technological leap.
The customer-first platform. When I read the details on this, I realized we are way past the era of chefs leaving voicemails for their rep at 2 a.m.
Completely. We are in a completely different paradigm. PFG has integrated sophisticated AI agents directly into their customer-first online ordering platform.
And these aren't just like predictive text algorithms or simple digital catalogs, right?
No, not at all. The AI functions as a digital operational partner for the chef.
Okay, put me in the shoes of that chef. I'm exhausted after a Friday night service. I log in to order for next week. What is the AI actually doing for me that makes me want to buy everything from PFG?
Imagine you want to add a new seafood pasta to your menu. Instead of manually cross-referencing prices across a dozen suppliers, the AI analyzes your existing pantry, looks at local pricing trends, and suggest the exact blend of ingredients you need to maximize your profit on that specific dish.
Oh, wow. It builds the recipe with you.
It does. It might suggest if you use this specific cut of whitefish instead of tilapia, your plate cost drops by 8%. And then it tells you the optimal quantity to order to minimize spoilage based on your historical foot traffic.
That is insane. It removes all the friction of menu planning.
Completely.
And by seamlessly solving the chef's problem, the AI naturally populates the shopping cart with PFG products. It builds deep structural loyalty. The restaurant becomes fundamentally reliant on the software.
Exactly. And the second mechanism driving this line's per drop growth is their private label program, which they brand as performance brands.
Which is doing incredibly well, right?
Oh yeah. They have reached a record 54% penetration in their legacy food service segment with these in-house products.
Meaning over half the physical volume they move in that segment is their own proprietary brand.
Yes.
Let's dig into the economics of that. Why does a private label matter so much to their bottom line?
It is all about vertical integration. When a restaurant buys a national name brand ingredient, that manufacturer has baked their own marketing, overhead, and profit margins into the wholesale price.
Sure, you're paying for the brand name.
But when PFG sources, packages, and sells a product under their own label, they cut out the middleman.
They absorb the manufacturer's margin.
Precisely. And they are seeing tremendous growth, specifically in center-of-the-plate items, high-value proteins, premium steaks, and specialized seafood.
Because PFG controls the brand, they can offer the local steakhouse a premium cut of beef at a slightly lower price than the national brand.
Right, saving the restaurant money.
While PFG simultaneously keeps a significantly thicker profit margin for themselves, it creates a highly resilient economic loop.
It's a win-win for the distributor and the independent chef.
So when you, the listener, see your favorite independent diner not just surviving, but actually maintaining their prices despite inflation, it isn't just because they have great recipes.
No, it's often because they have back-end partners like PFG actively optimizing their ingredient costs through private labels.
And streamlining their operations with AI. The distributor has evolved from a delivery service into an essential business consultant.
And that consulting relationship is what insulates PFG from the broader declines in restaurant foot traffic. They are capturing more value from every single kitchen they service.
Now, we've explored how they are optimizing the independent bistro, but their ultimate hedge against restaurant volatility is located somewhere entirely different.
Yes, a completely different sector.
We are talking about the convenience segment, gas stations, travel stops, and vending networks.
The convenience segment, operating heavily under their Core-Mark brand, was the undisputed star of this earnings report.
The metrics are phenomenal. Organic case growth in convenience was 8.3%. Revenue grew 8.7%, and their adjusted EBITDA, their operational profitability for the segment, jumped by 34.1%.
Massive growth.
Yeah. A lot of this was driven by successfully onboarding two industry heavyweights, Love's Travel Stops and Racetrack.
Which brings huge volume.
But again, I have to look at the macro environment. We just discussed how high fuel costs were hurting PFG's own delivery trucks. Historically, when gas prices spike, consumer discretionary income tightens.
That's the traditional logic, yes.
Right. So if it costs $80 to fill up a truck, aren't consumers just tapping their credit card at the pump and driving away to save money? Why is the inside of the convenience store booming?
It is a brilliant question. And the CEO addressed this directly on the call with a really counterintuitive piece of behavioral economics.
Okay, I love this part. Tell us.
When gas prices rise significantly, consumers experience what's called pump shock. They don't want to see a massive $100 total on the screen.
So they just stop pumping.
Exactly. Instead of filling the tank completely, they authorize $20 or $30.
They buy just enough to get through the next few days.
Right. But because they didn't fill the tank, they have to return to the gas station much sooner. Higher gas prices actually increase the frequency of physical trips a consumer makes to the station over the course of a month.
Oh, wow. I do that all the time and never thought about it.
And every single extra trip is another spin of the roulette wheel for the convenience store. It is another opportunity for the consumer to walk inside and impulsively buy an energy drink, a bag of chips, or a hot roller grill item.
So counterintuitively, expensive gas drives higher foot traffic inside the store.
Exactly.
That is fascinating consumer psychology. And speaking of shifting consumer behavior, we have to address the GLP-1 factor.
Yes. the weight loss drugs.
This was a major point of discussion during the Q&A portion of the call. The prevailing narrative in the financial press has been that GLP-1 drugs like Ozempic and Wegovy are going to structurally destroy the snack, candy, and fast food markets.
Because people simply won't have the appetite for them anymore.
Right. But PFG has actual on-the-ground consumption data across thousands of retail points. What is the reality?
The reality is far more nuanced than the headlines suggest. Because PFG supplies both restaurants and convenience stores, their data is incredibly granular.
And what are they seeing?
They noted that, yes, in the first year, a consumer is on a GLP-1 drug, there is a general suppression of appetite across the board. They see a measurable compression in snack and candy sales.
Which aligns perfectly with the medical intent of the drugs.
However, they are observing a distinct behavioral shift as time goes on. In year 2, the consumer's eating habits seem to normalize. The sheer volume of snack and candy consumption in their convenience channels begins to rebound.
Wow, really?
Yeah. The death of the candy aisle has been greatly exaggerated.
That's a massive relief for the convenience store operators. But what about the restaurants? If people are eating less overall, how does the food distributor adapt?
This is where we see true structural shifts. In the restaurant space, PFG is tracking a measurable surge in demand for high-protein and high-fiber items.
So menus are actually changing.
Yes. Consumers are actively requesting smaller portion sizes. But crucially, and this is wild because people are ordering full meals but eating less in a single sitting, PFG is selling a substantially higher volume of to-go containers and packaging.
That detail is incredible. The local diner might be ordering slightly fewer French fries, but they suddenly need to order twice as many plastic clamshells from PFG because every single table is taking half their meal home.
Exactly. PFG monetizes the food, and then they monetize the packaging for the food the customer was too full to eat.
It perfectly illustrates how macro health trends ripple down into supply chain logistics. The independent restaurants that adapt altering menus for higher protein, adjusting portion economics, and stocking up on premium to-go boxes, they are succeeding.
And PFG is supplying every step of that adaptation.
Okay, so they are brilliantly monetizing the shifting American diet. But we still have this 28% drop in net income hanging over the conversation.
Right. We need to circle back to the kitchen remodel analogy.
Exactly. Let's get into the actual mechanics of that expansion. A huge portion of this expense is tied to their recent acquisition of Cheney Brothers and the broader costs of scaling their physical footprint.
Right. If we connect this to the bigger picture, you see exactly how a logistics empire handles scale.
How so?
Well, to integrate the Cheney Brothers business and aggressively expand their market share in the Southeast, PFG recently opened a state-of-the-art broadline distribution facility in Florence, South Carolina.
And just to clarify for the listener, a broadline facility means it is a massive, comprehensive warehouse. It doesn't just specialize in frozen goods or fresh produce.
No, it stocks literally everything a restaurant could conceivably need, from raw chicken and bulk flour down to the napkins and mop heads.
It is a one-stop logistical hub.
Exactly. It's a massive undertaking. And the CEO explained a concept that was a primary drag on their earnings this quarter: double staffing.
Double staffing. What does that look like in practice?
When you bring a facility the size of Florence online, you can't just flip a switch. You have to hire, train, and fully compensate a complete warehouse staff and driver fleet to handle all the inbound inventory that is about to arrive.
But the catch is, before you actually migrate the client accounts over to the new building, you are still legally and operationally obligated to service those customers out of your older existing facilities.
Precisely. For a period of several months, you are paying 2 completely different sets of workers to manage the exact same volume of food.
It's exactly like paying double rent for a month when you're moving from your old apartment to a new house. It hurts your bank account today, but it's a necessary step to get into the bigger space.
Yes, it's like keeping a complete shadow crew on payroll.
Yeah.
You have the veteran crew running the current operations flawlessly so customer service doesn't dip,
while a completely separate, fully paid team is rehearsing in the new building, waiting for the signal to take over.
Exactly. It is an incredibly expensive redundancy.
It is expensive, but management was very clear that this is a non-negotiable, deliberate approach. They organized the customer transitions for the Florence facility into 4 phases.
Right, and they successfully completed 3, but they actively chose to pause the 4th phase.
Why pause it if it's costing them double rent?
Because of some initial weather impacts And because they categorically refuse to let customer service slip during a transition, they are not rushing the integration just to make the quarterly balance sheet look better.
They are taking the financial hit today to ensure the operational foundation is rock solid, and they aren't stopping to catch their breath either.
No, they aren't.
Right at the end of the third quarter, they executed another acquisition, Cashwa, a prominent distributor out in the Midwest covering states like Nebraska and the Dakotas.
Which signals to the market that this isn't a one-off restructuring event. This aggressive expansion is their core operating strategy.
Buy up regionals and plug them into the mainframe.
Exactly. They acquire strong regional players, integrate them carefully, absorb the short-term double staffing expenses, and then leverage the newly acquired capacity.
Like taking Cheney Brothers' highly successful regional private labels and pushing them out across the broader national PFG network.
Exactly. That cross-pollination of brands is where the real economies of scale kick in.
So knowing all this, the fuel headwinds, the double staffing, the transition pauses, how is Wall Street reacting and how is PFG managing those expectations?
Management took a very pragmatic approach. They did tighten their financial guidance for the remainder of fiscal 2026.
Right, they brought the numbers down slightly.
Yeah, they slightly lowered the top end of their sales target to a range of $67.7 billion to $68 billion, and adjusted EBITDA to $1.9 billion to $1.93 billion.
So they openly acknowledge that the fuel costs and the paused transition phases are real factors.
Yes, but, and this is the critical takeaway, they forcefully reaffirm their long-term 3-year targets for fiscal 2028.
And what exactly are they promising by 2028?
They expect to hit between $73 billion and $75 billion in total sales, with adjusted EBITDA scaling up to $2.5 billion.
Wow.
Yeah, they are telegraphing absolute confidence to their investors. They know that the heavy capital investments and double staffing costs suppressing net income today are the exact mechanisms that will yield massive structural dominance in the medium term.
It's a masterclass in holding your nerve. They know the logistics empire they're building is fundamentally sound, even if the construction costs sting right now.
Exactly. They are playing a much longer game than a single 90-day earnings cycle.
So bringing it all together, PFG is navigating a remarkably complex environment. They are battling stubborn inflation, managing the behavioral ripples of GLP-1 drugs, and operating in a sector where restaurant foot traffic is softening.
It's a tough market.
But they are plowing through those obstacles by fundamentally changing their role. They are leaning heavily into AI technology to lock in customer loyalty, pushing their high-margin private labels to over 50% penetration, and brilliantly dominating the convenience store space by turning the frustration of expensive gas into an excuse to sell more high-margin snacks.
It is a highly diversified, incredibly resilient business model that touches almost every aspect of the food economy.
It really is. So for you listening, the next time you stop to buy an energy drink at a racetrack because you didn't want to fill your tank all the way up, or you order a newly optimized seafood dish at an independent Italian joint, or you simply ask your waiter for a to-go box because you couldn't finish your meal, realize that you aren't just making a casual, isolated choice.
Right.
You are an active participant in the exact behavioral data trends driving a $16 billion quarterly supply chain.
And if we look at where all this data is heading, this raises an important question for the future of dining. We know PFG has this granular real-time data on exactly what consumers are eating.
Right, down to the specific shifts in protein demand and the increased usage of to-go containers.
Exactly. And we know their new AI agents are already acting as digital partners, helping chefs build recipes and optimize their ingredient orders.
Yeah, the AI is already inside the kitchen.
So with that level of predictive data and deep AI integration, how long until the food distributor isn't just supplying the restaurant's menu, but functionally designing it?
Oh, wow.
How long until the PFG algorithm tells the local chef exactly what the neighborhood wants to eat based on macro dietary trends and localized foot traffic before the chef even realizes consumer tastes have changed?
Wow. That completely flips the dynamic of the restaurant industry. The invisible machinery behind the kitchen doors doesn't just deliver the food anymore, it's actively deciding what the food should be.
Oh, it's a wild thought.
That is absolutely something to think about the next time you sit down and read a menu. Well, thank you so much for joining us on this deep dive. Keep questioning the invisible systems around you, and remember, the next time you think about how a business truly scales, sometimes you have to completely gut the kitchen and hire a shadow crew just to serve a better meal. See you next time.